Welcome to the deep dive. Today, we're looking at the 10-year Treasury yield.
Right.
Sounds a bit technical, I know, maybe a little in the
He
weeds.
can seem that way, yeah.
But it's actually become, well, a really big deal, especially for U.S. policy decisions.
Mm-hmm. Surprisingly central. We've got some expert analysis suggesting just that.
Exactly. So our goal here is to sort of unpack why this number, this yield, suddenly matters so much for the economy, for, foreign policy.
How the U.S. engages with the world.
Right. Is it like the new linchpin? Or maybe a vulnerability? Let's get into it.
Good question. I think for years, people mostly saw the 10-year yield as just, a market signal, kind of a mood ring for the economy. But what's changing, what the analysis points to, is that it's now something policymakers have to factor in actively.
Across a much wider range of decisions, too, not just finance.
Precisely. That's the core argument we're seeing. These rising yields aren't just a passive indicator anymore.
So experts are saying they're fundamental now, shaping trade strategy, how we handle the national debt.
Even international relations, it's quite a shift in perspective.
It really is. Can you remind us just quickly what that yield actually represents?
Sure. It's basically the return investors expect if they lend money to the U.S. government for 10 years.
So it reflects confidence in the economy, ability to repay.
Exactly.
Right.
And when that yield climbs, it could mean worries about inflation, or maybe higher interest rates coming, or just more perceived risk.
Okay. And how does that ripple outwards?
Well, rising yields mean it costs more to borrow money across the board. That can slow growth. And it affects how attractive U.S. investments look compared to other countries.
Right. So let's connect that to trade policy. How does a bond yield impact, say, exports?
Well, one key way is through the dollar. Higher yields can strengthen the dollar.
Okay.
And a stronger dollar makes American goods pricier for other countries to buy. Imports become cheaper for us.
So industries like farming or manufacturing, they could lose their edge.
Potentially, yes, if yields stay high. So analysts argue you can't really make smart trade policy now without watching the bond market closely. You need to anticipate those effects.
That makes a lot more sense now. And the national debt link, that seems more direct.
Much more straightforward, yes. Higher yields simply mean the government pays more interest on its debt.
Like the interest rate on the nation's credit card going up?
That's a good analogy. It costs more to borrow, leaves less money for everything else, puts a real squeeze on the budget.
So debt management becomes critically linked to understanding these yield movements?
Absolutely. Where they're going and why.
Okay, and the international policy angle. How does this domestic number play out globally?
It's really all connected. The U.S. 10-year yield acts like a benchmark for interest rates around the world.
A benchmark.
Yeah, it influences where global capital flows. Rising U.S. yields can pull investment towards the U.S.
Making our assets look good.
Right. But that can put pressure on other economies as money moves. Plus, it impacts how willing foreign governments are to hold U.S. debt.
Which has obvious geopolitical dimensions.
Wow. So our financial choices are deeply tied to global relationships.
Very much so.
Okay, so we've established this traditional indicator. The Treasury yield is playing a much bigger role. But the analysis also brings up Bitcoin, cryptocurrency. That seems like a leap into something totally different. How does that
But
fit?
it's definitely looking further ahead. But the idea is that these decentralized digital currencies, they might represent a pretty fundamental shift.
A shift in how money works.
Potentially. How we think about monetary systems anyway. As they get more adopted, the tech behind them, it could offer, alternative ways to do business maybe.
So the thinking is, these alternatives might eventually change how the whole economic model operates, maybe even lessening the importance of things like the 10-year yield someday.
That's the sort of potential disruption some see on the horizon, yes. It adds another layer of, complexity and uncertainty.
Different ways to value things, make payments, maybe even measure economic health itself? Could be. It's still early days, of course. But it's a factor analysts are starting to consider in long-term models.
Okay, so let's try and pull this together. The main takeaway feels like the 10-year Treasury yield is no longer just for finance nerds.
Definitely not.
It's now a critical piece of the puzzle for almost any big U.S. policy decision, trade, debt, foreign relations.
Has to be on the table.
And then looking out further, we have this potential disruption from digital currencies like Bitcoin, maybe changing the game board entirely.
Exactly. You have this increasing interconnectedness shown by the Treasury yield, and then these potential alternative systems emerging. It paints a picture of a really dynamic, evolving global economy?
So, something for our listeners to think about. With this web of connections getting tighter, driven by things like the Treasury yield, and with new financial systems maybe coming online, what could that mean for global economic power down the road? And, how might that change how you think about your own finances or world affairs?
Good questions to ponder.
That's your deep dive for today. Thanks for tuning in.